Hey there, everyone. In today's teaching lesson, we are going to review the process of estimating the intrinsic value of a corporation. We use Python and a Jupyter Notebook as always, and pretty much every example I've posted, every video I've done here, I'm using Python and Jupyter Notebooks. With one exception, I had one video that talks about beginner, intermediate, and advanced SQL, but I also used a Python notebook to demonstrate how that works. I like the way that you can export the code, and I'm going to do exactly that for you when the video is over. I'm going to save the file in HTML format and upload that with the video, so you'll have access to all the source code here. You'll have all the business logic laid out right in front of you, so you don't have to take a lot of notes and try to understand all the details and nuances of what's going on and understand all the nuts and bolts, because I'll give you the code and then you can take your time, pick through it, disassemble it, reassemble it, and understand the mechanics of what we're looking at here. So let's start with corporate finance. Intrinsic value is really the perceived value or calculated value of company, an asset, an investment, whatever the thing may be. It could be tangible, it could be intangible, but you're trying to determine what's the value of something. It could be a car, it could be a corporation. In this case, we're going to look at Apple, right? So we have all the public data. I think that's an obvious one. You can look at the calculating the value of a car, or whatever the thing may be, maybe a rare painting, but if it might be hard to get comparable values to make the kind of to make the kind of assumptions you have to make. Maybe for cars, if you have similar types of cars, you can look at comps. Those are short for comparables. But for a rare painting, it would be much harder to assess the value of that, right? But for a publicly traded company like Apple, it's actually fairly easy to look at these intrinsic values and understand what the company is worth today and what it probably should be worth. Okay, so we're going to focus on fundamental analysis. Fundamentals look at things like the industry, the position in the industry, any kind of risk factors, growth prospects, some kind of financial statements, right? You can look at cash flow statements. That's what we're going to focus on. You can look at income statements, balance sheets, right, and try to determine the value of a corporation. These are all popular methodologies. You can also look at discounted cash flows, abbreviated DCF. This is one method where you basically look at the present value of expected future cash values that the company will generate, and you discount everything back to today. So if a company hypothetically will generate cash flows over the next 10 to 15 to 20 years, you can take all that and discount it back to today, because we want to know what the company is worth today, not necessarily 10 years from now or 20 years from now. We're not waiting 20 years to make the investment. We're going to do it pretty much immediately, okay? So we'll look at that. We need to understand the weighted average cost of capital. There's a couple components that go into that. We'll take a look at that as well. We're going to not look at the dividend discount model. That's an alternative way to value a corporation. The best practice is probably to look at multiple different methodologies and then compare and contrast each. They will produce different results, almost guaranteed. They're not going to be the same, but it's fine. It's a different approach to solving the same problem, right? Different means to the same end. So it is a good exercise to look at several methodologies and deploy several models and see what the results are. And they should be somewhat comparable. If they're all over the place and none of them jive, then maybe you did something wrong, or your calculations are off somehow. So it is good to look at several different scenarios and then try to make sure that they all somewhat align. But again, they're all going to be different, and it could be off by millions of dollars, even hundreds of millions of dollars. And that's okay. We'll see why at the end of the video here. So we try to determine if a company's stock is undervalued or overvalued. If the intrinsic value is higher than the market price, then the stock may be undervalued, and it could be a good investment. If you jump in now, you could make a lot of money, right? Because the stock is actually worth more than the market perceives it's worth. That's why you do your analysis. But it's kind of a subjective thing too, right? Your perspective and my perspective might be different. So you could think the stock is undervalued. Someone else can think it's overvalued. If the intrinsic value is lower than the market price, then the stock is probably overvalued, and we probably don't want to jump in with both feet, right? We're not going all in on that. But again, it's kind of a subjective process, but we're going to try to objectify it as much as possible, so we can eliminate guesswork and try to make sense of whether or not this stock is a good investment or a bad investment, and remove all our biases towards that, right? We want to just run the calculations, the model says this is what it is, and we either take it, right? We'll invest the money, or we'll take a pass and move on to the next one. So that's what we're looking at here. So I'm going to go ahead and move down to the next cell here in my notebook and run this process to refresh the task of pulling in data from the web. Okay, this is, I think, the cash flow statement. Look at this. Yeah, cash flow. That's why I have my notes. So if you look at this URL right here, this is going to be the base URL. I will copy that and paste that into a new tab. And we can see what the raw data looks like. Okay, so this is all free. We get this from Yahoo Finance. Yahoo Finance is pretty generous. They give us all this structured data, cultivated, curated, structured in a way that's easy to consume and understand. So let me go up here and add a new tab here. Okay, I'll paste the base URL in here, and we will see what the source code looks like. I'm going to, meanwhile, I'm going to kick this off. It does take seconds to run the task and to do the import. Okay, and then we will come back and see what the raw data looks like. Try to maximize our time here and balance a couple different things. So if I hit Control Enter, this is going to run. I'm going to see the asterisk at the top of the cell here, and I see a small hourglass and a tab at the top of the screen here. So I know that's running. So let's just take a quick peek at the raw data, and you'll see what this looks like from Yahoo Finance, right? So we'll flip over here. Here's the breakdown. This is just a fancy way of naming all of those line items in the cash flow statement. Again, we have three that we focus primarily on: statement, balance sheet, and cash flow statement. And here we're looking at the TTM. This is trailing 12 months. It's just slightly higher than the 9/30/2023. That's the last time the Apple closed its books. So the end of September 2023. So we can expect an updated financial statement in just under a month here. Now is 9/5/2024. So within probably about 25 days or so, we can expect Apple to issue a new year-end cash flow statement summarizing what's happened over the past 12 months. Right, we're about 11 months into the close of the year for them, and all these companies can close anytime they want. A lot of companies choose to close at the end of December. It could be the end of September. It could be the end of January. It could be any month. Right, it's kind of an arbitrary thing that the corporation chooses, but a lot of companies do tend to do it at the end of the year. I think it lines up with the end of the calendar year. Pretty nice. That makes sense. But Apple's slightly different here. They do it at the end of September, not at the end of December. And that's fine. That's fine. That is what it is. So we see the raw data here, numbers. Operating cash flow is 113 million. These are all in, well, in thousands, right? But you can convert that. And then free cash flow, we see 104. If we go back to our data frame, we're looking at 113 and 104. All right. And then we go back here, scroll down just a bit, and we should see those numbers exactly the same. 113 for operating cash flow. All right, so that lines up nicely, and 104. So we have what we need. Pretty fast, pretty efficient. The code does a whole lift for us. This is called automation, right? You write the code, run it, and everything is done pretty quick and pretty easy. The benefit is obvious. You don't have a person to do this, so there's no opportunity to make mistakes, and it's very, very, very fast compared to a human being doing this type of thing. If they have to copy and paste it and put it into an Excel spreadsheet, inevitably mistakes will be made. You see this all the time in the news. Errors of spreadsheets cost companies hundreds and hundreds and hundreds of millions of dollars, sometimes on a scale of billions of dollars. So we have to be very careful working with Excel spreadsheets, because people are prone to make errors, right? It's just human nature. When you automate the process and use Python for this type of task, the errors are reduced to zero or very close to zero. It's very unlikely that the computer is going to make a mistake. Now, the data source maybe won't be refreshed. There could be a bug. The web is very dynamic. So Yahoo Finance works fine today. I wrote the code for it. I'm going to share this with you later. That could change in a couple of weeks or a couple of months or a couple of years, right? So I'm not saying this code is going to run forever. That's certainly not true, but we know it runs today, and although the web is dynamic and it will change over time, this code will probably run fine as is for quite some time. You're not going to have to make any adjustments or tweaks or updates. So let's go down a little bit. Let's make a prediction using Meta's, formerly known as Facebook. I think it's a funny name change. They changed it a couple of years ago. Good luck with that. So anyways, I'm not a huge fan of Meta or Facebook or any of these things, but they do have a pretty nice tool called Profit. It does time series analysis and forecasting historical data into the future. And in one of my other videos, I looked at a couple time series models. One of them was Profit. It really outperformed a couple other models I was working on. I think there was exponential smoothing and ARIMA. There's many ways to analyze data that's temporal. Temporal is a fancy word for saying time series, and time series is anything that shows transactions over a period of time. It could be stock market data, of course. It could be retail data. It could be weather patterns, anything that happens over time. It could be persistent and consistent. It could be repeatable. It could be somewhat random. Stock prices tend to be somewhat random, although kind of tied to intrinsic values and capex. I'm sorry, not capex, market caps, and we'll see that in a minute. So here we ran Facebook's Profit, and let's see what the outcome is. And again, I'm going to share all this code with you so you don't have to understand all the nuances and all the details. But we are doing a time series forecast, right? Based on historical data from 2023, 22, 21, 20. We want to forecast 2024. So we know this is coming out in less than a month, about 25 days. But we don't have to wait 25 days. We can do the analysis today and get a jump on the rest of the analysts on Wall Street and try to understand what's going to be presented to us when the numbers actually come out in about 25 days, give or take, and then start to make some investment decisions. Is this a good opportunity to go all in right now today? Okay, we see 207 for operating cash flow, 207 and 187 for the free cash flow. Let me go up a little bit. So what was 2023? We're looking at 207, 187. Go up a little here. Yep. So it's up a little bit, right? From 2023. And Facebook is going to make a pretty accurate prediction. So I think that's going to be accurate. I looked and compared this Facebook profit model to a few others, and the accuracy was pretty impressive. So I'm pretty comfortable with that number. Again, in 25 days, we'll see what the actual cash flows are for 2024, but I'm thinking that's going to be pretty close with just a small margin of error. It's not going to be exactly right? But I think it's going to be pretty close, and we can have a pretty high degree of confidence with that result, just because Facebook tends to, not Facebook per se, but Profit tends to make pretty accurate predictions given the assumptions that you feed into it. Again, 2023, 22, 21, 2020, we only had one record for 2019, so we're actually going to discard that. We're not going to use that year because one record for was this issuance of capital stock. That's pretty much useless. It's not going to help me at all to make my forecast into the future. So I'm going to focus on 2023 to 2020, and there's the numbers. Okay, so now we have our forecast, right? We have to generate. We have to make some assumptions based on the risk-free rate. Now the risk-free rate tends to be a little bit higher than it was a few years ago to the current economic conditions and the higher interest rate that we see in the economy. So a likely risk-free rate, which means basically you can make an investment in the company or the asset or the investment, whatever it is, could be around 4 or 5%. I think that's plausible. I think it's pretty realistic. A few years ago, before COVID, before all the inflationary pressures that we're feeling right now, it was closer to 2%, maybe even under 2%. So again, the risk-free rate is when you would charge a small premium because there is some small risk, but it's pretty unlikely, right? It's pretty unlikely that Apple will go bankrupt or that the entire economy will go bankrupt, right? If we look in a macro scale. Now, we did see some scary situations back in 2008 when we had the global financial crisis, right? That was highly unusual, but that's a situation or a scenario where comprehensively you have a lot of market risk and a lot of companies are feeling the pinch, right? There was a lot of cutbacks, a lot of stock prices depreciated for firms all over the United States, all different industries, different sectors, all over the world, actually, right? But the risk-free rate typically says that the market risk holistically is going to be pretty low, but we do have to add an equity risk premium, abbreviated ERP, on top of the risk-free rate. That is specific to the riskiness of the investment that we're underwriting, right? So we're considering putting some money into Apple. Now we can make an assumption that there's an additional 4 to 6% on top of the 4 to 5% risk-free rate just for the riskiness of this specific company. So again, Apple is highly unlikely to go bankrupt anytime soon, but there is a risk that could happen, right? You see these companies go belly up: WorldCom, Enron, Bear Stearns, Lehman, Long-Term Capital Management. Quite some time ago, that was probably like 25 years ago. The name was Long-Term Capital, and they were around for, I think, about 3 years, just under 3 years. So it really wasn't long-term at all. And that wasn't a publicly traded company too. That was a privately owned hedge fund. But anyways, these huge entities that are actually behemoths, they control a lot of wealth, capital, prestige, power, they can go bankrupt, right? So we do have to assume a certain riskiness for that investment. In Apple's case, I'm going to say it's 4 to 6%. Okay, so we've defined that. Let's do a sensitivity analysis. And in this case, again, we're going to look at the past 4 years, 23, 22, 21, 20, and try to understand what is the intrinsic value of this enterprise worth. So I'm going to go ahead and hit Control-Enter to refresh the code. Okay, and again, I'm going to share all this code with you so you don't have to make all the notes and understand all the details of what's going on here. All you have to do is download the file. I'll upload it when I load the video a little bit later today, and you'll have all the source code. So here we're looping through a few different discount rates in this list. So we have a list appropriately named discount rate. We're looking at a WACC of 0.05. Now that's pretty darn low. I don't think that's very realistic. We said about 4% risk-free and at least 4% for the riskiness of this specific investment, which is Apple. So probably a little bit closer to 8, 9, 10. That's probably ballpark. That's probably par here for the course. But I did include a couple lower WACCs just to show what the result is going to be. So the lower the WACC, the higher the intrinsic value, because the less riskiness of the investment, right? And if you have to borrow money to make this investment, the less interest you're going to pay in the borrowed money, right? But overall, it's looking at the riskiness of the investment. The less risky the investment and the higher the cash flows, the higher the intrinsic value, right? So you can see here with the discount rate is only 5%. Again, that's like pretty much best case scenario. Probably a little bit unrealistic. I don't think it's 5%. It's more like 8, 9, 10%. But you can see how the concept works here. The lower the WACC, the higher the intrinsic value. So at 5%, we have 9.3 billion, right? And we know that that's really overvaluing this company. We know it's closer to, I think, 3 billion now. But just to illustrate the point of how these WACCs work and how the mathematics works. And then if we assume incrementally that the WACC goes up to 10%, we have 2.6 million. I'm sorry, 2.6 billion. This isn't thousands, right? 2.6 billion. So you multiply by 1,000. And I think that's actually pretty much closer to the market cap that we'll see. And even here, 3.1 billion, and between 9 and 10, maybe 9.5%. I think that's very close to what the actual market cap is, and we'll see that in just a minute. So that's just one example of how to do the intrinsic value calculation and how to iterate a bunch of over a bunch of different WACCs and then come up with the intrinsic value. So how is intrinsic value similar to market cap? Intrinsic value is really the perceived calculated value of the asset, right? And the market cap is really a very simple calculation. It's just the company's outstanding shares of stock, the number of shares, times the value of the share of stock today. So the market cap is changing all day, every day. It's changing constantly throughout the day because the value of the stock is changing throughout the day. But the number of shares issued probably is not going to change unless there's a buyback or an issuance of more stock that's going to dilute the shares outstanding. A buyback will probably help existing shareholders, and more shares issued is going to dilute the value of everyone's existing shares outstanding. So we don't really want that. A buyback would be preferable if there's either one or the other. But with a company like this, those events are somewhat rare. You see that sometimes, but that's really the exception, not the rule. So again, why are we looking at intrinsic value? To try to understand and determine whether stock is overvalued or undervalued or maybe fairly priced, right? And why do we look at market caps? Well, we do this to try to understand the company's value today. It's a snapshot as of today at this point in time. As of is the key there because it's changing constantly throughout the year. So if you look on the Apple website. I put this code together yesterday as of 9/4/2024. That was yesterday for me. The market cap is 3.38 trillion, and you get that by multiplying. Where's my mouse here? I think I lost my mouse. By multiplying 221, that was the stock price yesterday, times 15 287 521 000. Okay, that's how we get to 3.38 trillion. And if we look up at the intrinsic value between a whack of 9 and 10%, or maybe 8 and 9%, we have pretty much the same intrinsic value as the market cap. Okay, so here's the calculation right here on this line right at the bottom. And we see just above that line, the market cap yesterday was 3.38 trillion. And again, looking at the whacks between 8 and 9, I guess you would have 3.7 trillion, 3.1. So it's probably 8.5% is probably a decent whack. So those align pretty nicely. But again, like, these don't have to align. They don't have to be very, very similar. The intrinsic value could be higher or lower than the market cap, or vice versa. It really depends on people's sentiment, people's confidence with the stock. Is there a lot of exuberance? Are people happy with the performance of the CEO, with the stock price overall? Is the performance justified, or is it irrational? Right? If the performance is justified, then the market cap is probably accurate. If it's rational, then the market cap probably is not. But the intrinsic value should be a more, I guess, robust or refined way to calculate the value of this enterprise, right? Or more rigorous way, right? Without introducing biases of people that are happy about the stock and they keep pushing up the stock price. That'll affect the market cap. It will have no impact on intrinsic value, right? So let's go down a little bit more. I think we're gonna be able to wrap this up pretty soon. This notebook is running really slow. As soon as I turn on my video recorder, everything slows to a snail's pace. I have no idea why. And normally the computer runs totally fine. When the video's on, it slows to a crawl, and I can't record the video without the recorder. So we're kind of in a tight spot here, but doing the best I can. So and a couple more things I have in my notes here. Market perception versus fundamental analysis. So market cap is the overall confidence or feeling of investors in the broader market, right? And fundamental analysis can remove some biases from the market cap numbers, right? Because we can do our own investigation, our own discounted cash flow, our own WACC, figure out our own risk-free rate, and then equity risk premium, like we saw before, right? So if we roll up our sleeves and do a little more work, invest some time, do some labor here, we can probably get a better estimate of the stock through the fundamental analysis that we're doing here, over and above what the market cap is. But the market cap is still important, right? We can't just totally disregard that. So let me look at a couple more scenarios here. We're going to focus on two types of analysis. I'm going to set this up with a few predefined functions here. Control Enter to refresh it. Okay, we're going to look at the adjusted cash flows. Okay, so we got that from above. We had the revenue growth, the margins, and the capex, right? And again, we pulled all this data from the web, from Apple's website. So it's not made up data. In some of my videos, I didn't have access to the data that I really wanted to. I just couldn't find it. I couldn't afford it. Sometimes you have to pay a huge premium to get access to certain data sets. But in this one, because it's all public knowledge and existing in the public domain, we can easily screen scrape the data and go get it. So we're going to have a very accurate final analysis here. We have the cash flows and then the forecasted cash flow. Again, that came from profit. All right. Profit in this case is Meta's profit. It's not the profit from making an investment or profitable payoff from this investment. It's a different type of profit. Spelled differently, but similar pronunciation, right? So let's look at two more scenarios, and I think we can wrap it up. I think we illustrated the point here pretty nice. So now we're going to look at scenario analysis, kind of similar to what we saw before with the different WACCs. We're looping over different WACCs, weighted average cost of capital numbers, and producing different intrinsic values for this enterprise. So that was pretty cool because we can not look at just one one type of potential outcome, but look at several simultaneously, right? So that's what the scenario analysis is going to show us. We're going to look at several potential situations in this calculation. So we have revenue growth of 3%, 5%, 7% margins. This is profit of 5, 10, and 15%, and CapEx, that's capital expenditure of 12, 10, and 8%. Okay, so these are flipping back and forth a little bit. We have increasing revenue, increasing margins, which is great. Both of those are great. CapEx decreasing, so another interesting scenario. Let me hit Control Enter to refresh this. And we have a few different discount rates, okay, 5, 6, 7. And we have our cash flows like we introduced before. Let me scroll down a little bit. And we have print out the results from these different scenarios. So let's dig in a little bit here. It's a little bit much to read here, but we'll get through it. 5, 6, 7% is the discount rate. The intrinsic value is 1.7 million and 7.89 million and 500. Okay, sorry, I misspoke. 1.1 billion, 789 million and 598 million. So again, as the discount rate increases, the intrinsic value decreases. We see that again, and we're also looking at revenue growth, margins, and CapEx. So now we can see discount rate relative to the intrinsic value, and then the changing revenue growth and the margins and the CapEx. So this is nice because you can see everything simultaneously. So this is very interesting type of view here. Let's look at one more type of analysis. Stress testing for potential economic downturns. Okay, so again, it's going to be looking at a few different scenarios simultaneously, and we can compare these side by side and see what the results are. So now we're looking at a drop in revenue of 10%, 20%, and 30%, and then margin compression, 5, 10, and 15. So the margins are going down. These are the profit margins, and the revenue is dropping. It's falling off a cliff here. So probably unlikely, but you can't say this can't happen, right? This is one potential scenario. You can have several different iterations of revenue drops. You can do 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Here I'm going in increments of 10, 10, 20, 30, and margin compressions going up 5% at a time. Again, this is a little bit arbitrary and subjective. It's up to you and what you want to look at, but I think this is a good starting point, definitely, and this can be a great place to end the video. I'm going to turn it off in just a minute, but it's a great place to pause and to set up a couple meetings with your key stakeholders. So talk to people on the management team, talk to people on the IT team, because Apple is a tech company, right? Talk to your salespeople, talk to your HR people. Do we have to hire more people? Are there going to be potential layoffs, right? Based on the valuation of this company, is the outlook rosy and it's optimistic, or is it kind of pessimistic and bleak, right? That's what all of these fundamental analyses are for stockholders, shareholders, for the management team, to understand how we compare with our competitors, right? To understand the landscape of the overall competition, right? So that's pretty much it, guys. So, but this fundamental analysis stuff is very important. Gives you more insight to the true value of the company and the perceived understanding of whether or not this company is overvalued or undervalued or fairly valued, right? It's going to be one of those three. It's going to fall into pretty much one of those three buckets. And those are all mutually exclusives, right? It can't be overvalued and fairly valued at the same time. That's impossible. It has to be over, under, or fair right there. So I think I'm going to wrap it up now. Hopefully you learned a few things. Again, I'm going to share the code, and I will drop this on YouTube a little bit later today. So check it out. Hopefully you learned a couple things. I definitely learned a couple new tricks putting this together. I have my master's in finance, or MBA in finance. Maybe it's a little different than a master's of science in finance. I have my MBA in finance. But yeah, I like to share my knowledge with other people and help people to make informed, intelligent decisions, so you understand what's going on, and hopefully profit from this newfound knowledge. Okay, thanks for your time today. Have a wonderful rest of your day. Goodbye.